and gentlemen, I'm Renee Springstead on behalf of everyone at Fross and Fross Wealth Management, the staff that's back in the office, especially the investment committee, and Tom, who's out in Wyoming and not able to make it today. We just want to welcome you to our presentation. It's obviously very perfectly timed with everything that's been going on. It was a little windy out there when we were walking in today, and I think we just have been fighting two storms, right? We had the storm out in the ocean over the weekend, and then we had a little bit of a storm in the stock market. So I'm going to have Patrick come up here, and he's going to talk about investing in times of political uncertainty, and he'll be covering a little bit of what we just experienced over the last couple of days with that volatility in the market. So again, thank you all so much for joining, and here's Patrick.
All right, hello everyone. You look fabulous. It is so nice to see everyone. Thank you for being here. We spent a lot of time and effort putting this together, so it really makes us happy to be able to present it to you and actually have you be here. So thanks for being here. This slide, we have to show this every time. These are the disclosures to keep the attorneys happy. Basically, it tells us there is no perfect investment, but I think you know that. If it sounds too good to be true, yeah, probably is. You weren't born yesterday. So we're not going to give a recommendation on a specific stock or specific investment today. That would be appropriate. You know, most of you are clients, but we have some visitors here as well. And for those of you, we make recommendations based on your situation, your goals, objectives, your feelings on risk, your desire to pass on assets, your tax situation, income needs. All those things are taken into consideration before giving a recommendation. So we would get to know you first and so on. But we're going to talk about general investing principles. We're going to talk about current events, a little bit about politics, not too much. We get everybody riled up, but there's plenty of that going on. I already did this to my cell phone, so you might want to silence yours. All right, so let's start by talking about the elephant in the room. And when we first put this presentation together, we thought that'd be easy. We thought we'd be talking politics. But let's back up a minute. Because something very interesting happened yesterday. And unless you live under a rock, I'm sure you're aware that the Dow was down 2.69% yesterday, over 1,000 points. The S&P was down about 3%. The NASDAQ was down about 3.5%. And the Japanese Nikkei index was down 12.5%. The biggest drop, one-day drop, in the Japanese Nikkei since 1987. It's a big deal. And what caused all that volatility here in the United States? Well, we think the majority of it had to do with the Japanese carry trade. I think that was a big part of it. If you're not familiar with what that is, it's where over in Japan, they were leveraging money to buy risky stocks. So, to give you an analogy, imagine that a car dealership called you up about 2 years ago and offered you 0% interest to buy a car. And you thought, well, I don't really need a car, but I want a car so I can make money, so you decided you were going to pick a car that you thought was going to go up in value. So let's say you picked a Corvette C8 Stingray. Because 2 years ago, you could buy one at MSRP and then sell it 3 months later, and you could make about $15,000. So why not? So you took this bank loan, 0% interest, you bought the Corvette, and at the beginning, it was working out great. You were watching the value of that go up, and then what happened? Well, the value started going down instead of up. And not only that, the bank called you up and said, we're changing our terms, we're going to start charging you 10% interest on that loan. Well, you and all your buddies had done the same thing, so quickly you sell the car at a discount to repay the loan, and you had to take a loss, and it started this snowball effect. Well, essentially, that's what was going on in Japan. They were leveraging money, 10 to 15 times leveraging, in order to buy risky assets. So they would convert yen into US dollars, they would buy US stocks. the Magnificent Seven, Apple, Google, Facebook, NVIDIA, and so on. And, well, we know what happened. Japan's been behind the curve. They've been at a 0% interest rate this whole time. We raised rates 2 years ago. They haven't raised them until recently. And they went from 0 to 25 basis points. Amazing. And so the same thing that happened to us 2 years ago has happened in Japan. They're just behind. They're just a little bit behind the time. But you also may be aware that today things kind of flipped the other way. Although the Japanese Nikkei index was down 12.5% today, of course they closed before us because of the time change, but they were up 10.23% today. So a big flip, and that happens a lot. A lot of times we'll see this flash crash, and very quickly we get a recovery. The market, maybe an hour ago when I checked it here in the U.S., the Dow was up 588 points, 1.5% increase. The S&P was up 2%. The Nasdaq was up 2.2. So we think a lot of what happened yesterday here in the U.S. had to do with the Japanese carry trade, probably about 75% of that volatility, and some of it had to do with Jay Powell and the Fed possibly being behind the curve, maybe some geopolitical risk with China and Iran, and of course Kamala Harris maybe doing a little better in the polls than what was thought originally. So let's dive into the politics a little bit. Of course, the elephant in the room, we know that's Donald Trump, or we could talk about the other political party. Now let's talk about the election news that you may not hear. You may not hear it on CNN, you may not hear it on Fox News. And that's really something that Thomas Jefferson said. Very interesting. In his inaugural speech, he said, "We are all Republicans, we are all Federalists." What he was really saying is we're all Americans. And we have seen such political polarization in this election cycle, and it just seems to be getting worse and worse. And I think that's a really sad thing. But I don't know if it's going to get better. In fact, it may just be getting worse and worse. And we have a tendency to take our views on politics and blend that into our investing style. For example, back when Bush was president, 2000 to 2008, you can see that Republicans, or those that leaned Republican, rated the economic conditions as excellent or good, and Democrats rated economic conditions as bad. Obama comes in 2009, it flips. Those that lean Democrat viewed economic conditions as good or favorable, Republicans the other, and then we get Trump, it flips again, and so on. So you can see how there's this tendency to take who we believe is the best person to be in office and translate that into how we feel about the economy. However, this is very interesting. A $10,000 investment in 1949, if you had only invested that money when your party was in power, this would have been your growth. Republicans, Democrats. If you had stayed fully invested with that $10,000, regardless of which political party was in power, your $10,000 would have grown to over $1 trillion. 4 million, I should say. We'll get into $1 trillion in a minute. It's a whole other subject. But at any rate, I know it's a difficult thing to do because we're all emotionally invested, not only in our money, but we're also emotionally invested with what's going on in politics. And one thing I would admonish you is try to separate the politics from the investing. And I know it's a very difficult thing to do. Very difficult. But I would admonish you to do so. During presidential cycles, the fourth year tends to be the second best. The average is over 10%. You know, right now the S&P is already a little over 10% for the year. So we're on track for that average. This is very interesting. Whether or not it's a Republican president or a Democrat president doesn't make a lot of difference. What the market likes is a divided Congress. The market has a tendency to perform the best when nothing's going on in Washington. The market loves gridlock. Because what does the market hate? The market does not like uncertainty. So when Congress is in there passing bills and changing regulation, that's bad for the market, that's uncertainty. When it's a divided Congress, and there's all this infighting and polarization going on, the market loves that, it performs best, irrespective of who the president is. So a lot of it has to do with the Congress. This is going to be very interesting to see because we don't know if we're going to end up with a divided Congress. Right now it looks like that very well could be the case, so that may be good for the market. When we put this slide together, this was going to be the Democrat candidate, of course now it's Kamala Harris, and but we left it up there because a Kamala Harris administration would end up being just an extension of the Biden administration. So there's not going to be a lot of difference. If Trump is elected, the marginal tax rates will stay, the top tax rate will stay at 37%. That's because he's probably going to work hard to extend the Trump era tax cuts. If there is a split Congress or Democrat Congress under Joe Biden, then what will happen is these tax cuts will automatically sunset. So it would take action by Congress in order to extend those. So we'll see what happens. Right now, we're giving Trump about a 51% chance, Kamala Harris about a 45% chance. That could change. Think of how different it was from just a few weeks ago. Think how quickly things can change in around politics. So what do you have coming up? The Democratic convention's coming up. That's usually a little boost for who's ever doing the convention. And then we'll have a debate. We'll see. It'll be interesting to see how things end up being. One of the things we're watching really closely, though, we can talk about the SALT caps and the child tax credits and all that, but really what's going to matter as far as the market is concerned is going to be the corporate tax rate. Trump says he wants to keep it at 21 or possibly cut it. We know that Kamala Harris, she wants to raise the corporate tax rate possibly to 25 or 28%. And we think that would be bad for the market. Economic events worth watching. So as an investment committee, you're probably aware of this, but we get together a lot of meets in our conference room. And we spend a lot of time talking about the market, the economy. We talk about what happened yesterday. We all put our heads together and did our research, and that's why we're here today, bringing that research to you. But there are some things that we talked to you about at the beginning of the year, at the meeting that we had, I think it was right around the 1st of February. And we brought you some forecasts for the year. We want to talk about that a little bit and how it dovetails into our forecast now. So we brought you this poll that was done by the Federal Reserve and Goldman Sachs. And they put out this poll on the likelihood of a recession in 2024. It was very interesting. So economists at the time, at the beginning of this year, about 50-50 split on whether or not we'd have a recession. Consumers thought 69% of consumers felt there would be a recession. CEOs, overwhelmingly, 84% of CEOs of Fortune 500 companies felt that there would be a recession. The economic data, these are the Rockdale speedometers, showing the 20 leading economic indicators. At the beginning of the year, we had a lot of yellow, we had some red. We were off to a rocky start. It was a rough start at the beginning of the year. Consumer sentiment was low, as you can see over here. And also we had an inverted yield curve. Why is that significant? Well, an inverted yield curve has predicted the last 7 recessions. Here we are. the yield curve inverted 2 years ago. Could this be the one time in history where an inverted yield curve does not wind up in a recession? Yeah, of course it could. This could be the exception to the rule. But it seems unlikely when yield curve inversions generally forecast a recession. Credit card balances, there's your $1 trillion that was stuck in my mind. I just still can't believe that. We were at lows here during the pandemic. 2021, nobody was spending money. They just hung out at home, watched Netflix, cleaned their closets. I mean, you were right there. Not a lot going on. Look what's happened since. Credit card balances, those stimulus checks wore off. They spent that money, and now people are running up the credit cards because what we found with inflation is that people have not stopped spending money. You would think that that would slow down the spending of money, but all it's done is force people to put things on credit cards. And unfortunately, that's been the result. And this can be problematic for a future recession. We've also seen early delinquencies in loans, both auto, credit card, and student loans. I won't even jump into the student loan thing because I don't even want to talk about that. But I think you get the point that when we see delinquencies, that's kind of an early sign of problems in the economy. ISM Manufacturing Index. Now, in all fairness, this was from June, and we got some bad numbers in June. The number that came out yesterday, intraday, was a little better on the ISM, and that's why we were down way over 1,000 at some point, and then in intraday trading, the market bounced back a little bit. A lot of it had to do with the ISM Manufacturing numbers, so we're seeing a little softness there, but a little better than what we had in June. And of course, the Fed rate hike that we've seen over the last couple of years. The steepest rate hike and the fastest rate hike in history, which is typically predicted a recession. Now, we went back and looked at the last 13 primary Fed tightening cycles, starting in, we don't show the one in the 60s, but the one in 1974 and so on. Every one of these Fed rate hikes, with the exception of 1984 and 1995, led to a recession. 13, let me say that again, there's been 13 Fed rate tightening cycles, 10 and in a recession. Only 2 have not. Could this be the third time in history the Fed rate hike cycle does not end in a recession? It's possible. It could be. Seems unlikely. I think what we're seeing right now is very reminiscent of 1966. We had low unemployment, inflation went up, the Fed took their foot off the brake, they started cutting rates. And what happened over the next 36 months? We had inflation go back up to 6.2%. So that's what we're a little concerned about. We didn't see a recession for 4 more years, but we did see this double dip recession, or inflation that took place. And I think this is the closest, I think, correlation that we have today. There's another one we're going to show you from the 70s, but this is about the closest that we can come up with today. So it is one of our concerns, is that when they start cutting rates, we could see a problem with inflation again. So it brings up the question, low unemployment, because that's what we do have right now. Does that mean we cannot go into a recession? We hear that all the time. You can't go into a recession, we have low unemployment, right? Well, we went back and did research. Here's what we found. The last 9 recessions going back to 1960, this purple line was the unemployment rate. The shaded line was the recession. The green is the S&P 500. That vertical line is the low point in the S&P. But here's the point. That purple line shows that we had very low unemployment just prior to the last 9 recessions. It kind of blows that theory out of the water. Yes, you can have very low unemployment just prior to the recession. So I think that myth is busted. However, the financial indicators have come back These are the indicators for July. Much, much better than we saw in January. We've got a lot of green there. So it's possible that we could be in for a soft landing. I think the jury's still out on that. I would be remiss, though, if I didn't bring up inflation for a minute. And I think all of us have felt that. Goods over the last couple of years are up 42%, services up 35%. We're all feeling it. Headline CPI right now has come down to about 3.3, 3.4 on core. So we have seen it come down. Inflation, is it the result of corporate greed? Because that's what we've heard on the news. They're saying it was transitory, it was corporate greed, it was just companies that just wanted to charge you more money. They're jumping on the bandwagon. They don't want to miss their opportunity to raise prices. Well, the answer is no. Inflation is the direct result of the printing of money. Milton Friedman, who we are big fans of him as an economist, always stated that there was about a 2-year lag between the printing of money or an increase in M2 and the effect that resulted in inflation. So the biggest one here, March 11, 2021, the American Rescue Plan, there were trillions of dollars. Think about it. $7 trillion almost printed out of thin air. And that money was given away. Now, we didn't have inflation back in 2009 through 2015, and they were printing money then. Well, the difference was they didn't give the money away back in those days. It didn't increase to M2. It was an M1, it wasn't an M2. M2 is the money in circulation. This time, when they started printing all this money in 2020 and 2021, they actually sent it right to people at their homes. You got those checks in the mailbox, right? You got those checks, everybody got those checks. And that money was sent, it went into circulation. It went into the economy, and that's what caused it. Will an increase in unemployment slow inflation? Again, we don't see that. What we see is a direct correlation between M2 here. This is a peak of M2. 2 years later, what did we see a peak in? Inflation. It's a very simple concept that the government never talks about it. The Fed doesn't want to talk about it. They don't want to talk about M2 because it's so political. If they talk about M2, if they say, well, we have inflation because we printed too much money, and we're going to fix it by printing more money. They can't say that. So they have to say it's transitory. They have to say it's corporate greed or the result of lockdowns. But you're never going to get the truth out of Washington. But this is the truth right here. M2. And the reason why we talk about that, and I'm not going to, Renee earlier, she's like, Patrick, don't nerd up too much on M2 because they're just going to get bored. Well, I'm going to try really hard not to get too much into the weeds here. But here's why we're watching M2. This is very, very important. Okay? I said it peaked 2 years ago. There's the inflation. What's happened since then is M2 started to drop. There's been a drop in M2 from early 2022 through late 2023. And of course, what happened? We saw a drop in inflation. It's directly correlated. So here's what we see. 3 possibilities with M2. This is why we're watching it so closely. If M2 continues its modest 2.3% annual rate, since we've had it in October, it's very possible we could have a soft landing. That's what we're hoping for. The second possibility, if M2 resumes its decline, because we saw this big, big drop in M2 right here. And the last time we had a drop in M2 like that was just before the Great Depression. So that was kind of scary. We were watching that really close going, oh boy. This is a scary thing. But then we started to see it go back in October, and I think that's what's contributed to some of the possibility of a soft landing. But if M2 resumes its decline, that would raise the risk of a recession. If M2 surges again and starts to go up, it could herald a revival of inflation like we had in the 1970s. When these guys were around. Chasing down the bad guys. The 1970s. Who remembers the 1970s? Yeah. I was just a little kid. I don't remember it that well, but I sure remember these guys, and I'm starting to think it was maybe reruns. But one rerun we don't want to see is this. That's peak inflation in 1974, right there. Inflation came down, and then what happened? It went back up. We don't want to see that rerun. This is inflation. We overlaid the chart. This is inflation now. Inflation's come down. We don't want to see that happen. Inflation is a cancer in the economy. Because that money's gone forever. Think about it. If the stock market drops, as long as you don't sell at the bottom, what happens? It goes back up. Inflation, that doesn't happen. When we have inflation, you never get that money back. Inflation is a cancer. We got to be very careful about that. So we're watching them too. We're watching the Fed. We're very, very keenly interested in what's going on. Planning for the unknown, and the reason why we named it the unknown is because the next slide is going to illustrate how difficult it is to forecast what the market's going to do in the future. It's extremely difficult. We brought you this chart back at our meeting in the beginning of February. And I wanted to share it with you again because I think it just so nicely illustrates how nobody knows what's going to happen in the market. So over on this side, these were forecasts for the S&P 500 for 2024. We had the bulls over here: Funstad, Oppenheimer, BMO, Citigroup, Deutsche Bank, Goldman Sachs, BOA. They were all bullish. They thought the market would be up. But over here, we had the bears: J.P. Morgan, Cantor Fitzgerald, First Trust, Morgan Stanley, Scotiabank, Wells Fargo. Bunch of peasants over there. And what was the group average? 1%. You add all that together, the bulls, the bears, you put them all together, and they thought the market would be up 1% for the year. And I think it might as well be zero. I wish it was just zero. I think that would have been a better story, right? That was the average. But 1%. We went back and looked at the forecast from the same guys going back to 2020. Very interesting. In 2020, the average projection was 3.2. The actual return was 16.3. In 2021, the average forecast was 7.7. The actual was 26.9 on the S&P. In 2022, the forecast was 4.2. The average was negative 19.4. In 2023, the forecast was 6. The market was up 24. What does that tell you? Nobody knows. The so-called experts, and it's not that they're stupid. These are some of the smartest people in the world. PhD economists. But they're all using assumptions on what the Fed is going to do, on where interest rates are going to be, where corporate profits are going to be. And they're feeding that into their own algorithm, and they're using that model to spit out a number. And it's not that they're not smart, it's just nobody knows what the Fed's going to do. We have a pretty good idea. We think in September they're going to cut. They might even cut 50 basis points now. That's kind of the prevailing wisdom. Now, there was some talk yesterday about the possibility of an emergency rate cut. We think that would be really unwise. We think it would send a really bad message that there's a problem in the economy. But there's a very good possibility in September we could see 25 or 50 basis points. And maybe, even though they don't want to cut in November because it's, it would look bad, it's an election month and so on, it's very possible they may cut in November as well. And of course, yesterday, we all experienced this volatility. So let me ask you this: is volatility a bad thing? You're all going, yeah, I hate volatility. It was scary yesterday. How many of you were checking the market yesterday? Just kind of checking it out, and kind of wondering what's going on, and checking your phones. Yeah, pretty interesting. But I want to illustrate why volatility is normal, because it really is. And And I know the market's not for the faint of heart, but in order to be in the market, you have to accept the fact you're going to feel uncomfortable part of the time. And if you can accept that uncomfortable feeling part of the time, you're going to be a successful investor. So, blowing that chart up, this goes back to 1980. I don't remember 1980. I was 9 years old. I'm delivering newspapers. I just, I wasn't looking at the market. But at one point in 1980, the market was down 17%, but it finished the year up 26. Now, that's some volatility right there. Down 17, up 26. I mean, think about it. And I bet you, babe, you don't even remember 1980 in the market, do you? You might remember working and raising kids and all that stuff. You don't remember 1980. What about, let's see, 87? There it is. That's the big one. Right here, market was down 34%. Was 1980, did it end up being a good year or a bad year? I'm going to take a poll. Now look at the chart. Good year or bad year? The market ended up 2%. But I bet if you did the, Water's World, you ran out on the street and you asked them, is 87 good or bad? What would they say? They'd probably say bad. Because we all think in 1987, Black Monday, terrible. Let's see. You know what I remember about 1987 though? Because I do remember 87. I was a senior in high school, and I had an economics class, and I was there in school, and the market dropped, and me and my other geek buddies were standing there, and we're talking about, oh my gosh, what should we do? Should I tell my dad to sell his 401k to go to cash? Like, what do we do? Like we had any control over it. And the professor comes over, economics professor, seasoned, experienced professor, comes over, and he says, gentlemen, you tell your dads to put more money in their 401ks today. This is a buying opportunity that you will never see again. I gotta tell you, this light bulb went off in my brain. That stuck with me to this day. Amazing. What a wonderful piece of advice. The opposite of what we normally do as humans. When we see something like this, the normal human response is panic, sell, run for the exits. But instead, if you were in the Japanese Nikkei yesterday, can you believe what a buying opportunity that was? You would have made a 10% profit one day if you jumped in and bought it. How many people did it? Some maybe, but that's not the normal human reaction. We could go through, I remember after 87, I remember each one of these years, I remember where I was, everything. Here we are, was that 5 or 6%? I looked at my computer, looked at the market. We had a little correction in the NASDAQ. We know the NASDAQ down about 11% from its high. The S&P maybe down about 8%. The S&P hasn't even had a correction. Think about that. The market was down so much yesterday, the S&P hasn't even actually had a full-blown correction. And yet, there's so much panic and worry about the market. Here's the point. Volatility is normal. The market goes up, the market goes down. Some days are going to be rough. 94% of the years, the market has a 5% drop. So if you have a year without a 5% drop in the market, and how much was it down yesterday? 2.5%, 3% on that on the NASDAQ. If you go a year without a 5% drop, that's a weird year. That's the year where you got to say, what's going on? Something's weird. We're not getting the pullbacks like we should, because pullbacks are normal. It's part of being in the market. Another myth that we hear a lot is that if the market's at an all-time high, you should not invest your money. You should wait. Sounds like it makes sense, right? We went back and did the research. If you invested at a new high, on a new high, your money would be here. If you invested on any other day but a new high, your money would be here. Historically, investing when the market's at an all-time high has actually worked out. Now, I am not advocating for that right now. I do think the volatility will continue, and we do think that the market, based on our capitalized markets formula, is slightly overvalued at this point, especially in the NASDAQ. It's still a little rich. We've seen a little pullback. That's good. You needed to blow off some steam. We needed to see that. With the possibility of a recession, I think we need to be smart about it. We don't have one of these. And I love what Andrea did here. See, I found the picture, but isn't this cool? Thank you, Andrea. That was awesome. I don't even know how you did that. Magic. So the probability of positive returns. Now, we talked about what we don't know. We don't know how the market's going to close the year. We don't know exactly what the Fed's going to do. We don't know what inflation's going to do. We don't know where M2 is going to be. Those are things. Here's what we do know based on historical precedent. In every 1 year period, the market is up 77% of the time. What does that mean? Flip it around. Converse. 23% of the time, the market is down. We know this. It's not, again, I said this a few minutes ago, it's not the market going down that's the problem. The problem is if you have to sell when the market's down. That's the problem. So if we know that there's a 23% chance the market's going to be down in a 12-month period, and you need money in the next 12 months, we think you should be safer with those assets than having them in equities. We're in a good situation right now with interest rates. The silver lining is that interest rates are more than they were the last 15 years. So you can actually make money in CDs, money markets, and treasuries. However, if you look at 5-year periods, the market's up 93% of the time. 12-month periods, 97, or 10-year periods, 97% of the time. What does that tell us? So that tells us if you're taking money from your portfolio, that we should be doing buckets of money approach. Money that you need now should be very conservative. Money market, still making around 4.8%, fully liquid. Money you need soon, you still want an inflation hedge. CDs, structured notes, treasuries. But your long-term growth money, that should be more aggressively allocated. Equities have always been the best hedge against inflation long-term. Now, we're not going to force you to be more aggressive than what you want to be. And if you're going to tell us your appetite for volatility, we're going to figure that out. Because we want to keep you engaged. We want to make sure that you don't ever panic and sell at the bottom, because again, that's the worst thing you can do for the portfolio. But if you are taking withdrawals, and most of you are, at least your R&Ds, if you're taking withdrawals from your portfolio, I'm sure that you've met with your advisors over the last 6 months or 12 months, and we've set money aside for the short term. And if you set money aside for the short term, money that can't lose, you can't lose any money because you're in money market CDs, structured notes, treasuries, and the market drops 1,000 points, what can you say? No big deal, right? It doesn't affect me. You might pull up your statement, you might look at your bottom line, and there might be a temporary decrease in your overall portfolio value. But over the long term, it's not going to hurt you. And think of that feeling, that sense of security, knowing that your short-term assets are protected. Money you need in the first 3 years. But money you don't need for a long time, it would be silly to be conservative. We continue to do ongoing monitoring and adjusting to your portfolio. We craft strategies and we build connections. There's a few things that you may not be aware of that we do as an investment committee and as advisors for you. And we just wanted to mention a few of those. Besides comprehensive portfolio management, we also do ongoing investment planning, cash flow planning, tax planning, income distribution. Social Security analysis, for those of you that haven't started Social Security yet, please bring us your statements. We'll help you make a good decision on the best time to start Social Security. We can help you with estate planning, long-term care planning, insurance review, retirement planning, insurance solutions, business exit planning. For those of you that may have businesses, we have extremely good connections with LPL on helping with business exiting. College planning, corporate trustee services through a private trust company, coordination with other professionals, CPAs, attorneys, etc. And also, this is a sounding board for family members that may want to just get some advice. We don't charge for that. If you have a family, a son, a daughter, or a grandchild, and you think it would benefit them to come in and talk to us, we'd love to talk to them and help give them some advice. Maybe helps get them pushed in the right direction. So, there's a lot of uncertainty in this world, and I don't think that's ever going to end. We're always going to be wondering, what's the next shoe to drop? Are we going to end up in a war with Iran? Or is China going to do something? Or what's the next thing that's going to happen in Israel? And are we going to have a recession? Are we not going to have a recession? There's so many unknowns. We want you to know that as an investment committee, we are here for you. We are here to meet with you and spend time, as much time as you need, going through your portfolio, helping you understand what you own and why you own it. If you don't know that now, please talk to us, and we'll help explain what you own and why you own it. And if there's anything that you feel strongly about, please bring that to our attention. If there's things that are worrying you, things that are upsetting you, please bring that to our attention. And we're happy to be a sounding board for any decisions, financial decisions, personal decisions. We're happy to help you with those things. So I got to tell you that we have, and Renee and Zechariah and Casey and Tucker, they're all going to say the same thing. We have the best clients in the world. And I don't know if it's because y'all live in the villages and you're just all happy. I don't know what it is. But you guys are wonderful. And we really, really love what we do because we get to spend time with you. And I got to tell you, that's a privilege and it's an honor. So before we end today, I want to say just a couple things. Andrea just reminded me of something that she wanted me to mention. First of all, there's some feedback cards on your chair. If there's anything that you'd like to mention, please write that down. And for those of you that are visitors, thank you for being here. We appreciate you coming if you're not a client. Please fill out the card if you're not a client. Let us know if you'd like to meet with us or not. We're happy to do a complimentary portfolio review, and we can dig in the weeds. We can tell you how much risk you're taking, and how good your Sharpe ratio is. And Renee will even get up here and explain what Sharpe ratio is. Also, we do want to mention, this is the first time we've announced this, so thanks for coming, because we're announcing that our next concerts that will be held at Tom's Farm, the Fross Farm, will be March 22nd. And we can't send out an invitation yet, but we just thought we'd give you a heads up if you want to mark the date. March 22nd, the band is Hayfire, they're a country band. I hear they're really good. But it'll give you an opportunity to wear your cowboy hat and your cowboy boots. Come on out. I just wanted to just take a minute and introduce our investment committee. And with the exception of Tom, is Tucker here? No? Okay, so we're missing Tom and Tucker, I'm sorry. So it's not going to be a full crew. But I'd like to invite Casey and Renee and Zechariah up to the front. Come on up stage, guys. Right on stage. I just want to introduce everybody. And this is I guess we're just missing this big guy right here. Well, I'll just stand here. We can pretend time is here. Okay, right there. So you got right there. Okay, good. So Tom's with us in spirit. And also, you may or may not know this, but Tucker does our trading. Tucker's an advisor also. We call him the whiz kid, super intelligent. And he's at the office because it's not 4 o'clock yet, so you know what he's doing. He's doing trading. And if any of us, if you talk to us, you say, I want to buy this and sell this or do rebalancing, we tell Tucker, and Tucker does it. So, and he also chairs our investment committee. So, at any rate, we all got together with Casey and Tucker and Tom and all of us as a group here, and we spent a lot of time back in July putting together these slides. They've changed by the day. So, thank you. And I just wanted to mention that because it truly is a team effort. Everything I spoke today, Renee introduced me. Maybe next time it'll be somebody else that speaks. But I just wanted to mention that because as a committee, we all, not to mention the fact that we all enjoy working together. We have good camaraderie. But we enjoy getting together and talking about these things. And I know not everybody enjoys that stuff, but we're a bunch of nerds, okay? We love numbers, we love charts and graphs. This is our world, and thank you for sharing our world with you. I really appreciate you being here. We're going to be serving, for those of you interested, some wine and beer and other drinks. If you're not a wine drinker, we have some other refreshments back there. So, on behalf of everyone at Fross and Fross Wealth Management, our investment committee, and all of our staff, thank you for being here, and we look forward to answering your questions in the back as we enjoy a glass of wine together. Have a great day.